welcome to the final Galileo Capital update for 2025. I'm joined with Theo. We don't do many of them together anymore, Theo. We're recording in the last working day of November. And so if you're watching this and the world's fallen apart in December, I'm sorry, we wouldn't have known about it. But what we can tell you is all the rugby results bar one have been fantastic for South Africa. But yeah, it's been a cracking year for investors all around.
Yeah, hello, Warren. Yes, it's certainly been an exceptional year. And I think before I start to look back at the year, last year this time, if I would have told you that the JSE All-Share Index will be up by 30%, you wouldn't have believed it.
No, not even measured in dollars.
It's a phenomenal run.
Yeah.
It's even higher in dollars because the rand started the year at around about 1880 and we know about 1720. So the rand strengthened. Incidentally, that also creates that probably one of the worst asset classes the last year was cash in dollar terms in America. Why? Interest rates started to come down and the rand strengthened. But that's another point. So if we look back at the year, the JSE All-Share Index is up north of 30%. It's been a massive run. That's against a background of inflation, let's say between 3 and 3.5%. So it's a massive real return. That return, if you break it up, just to see where it came from. If you look at the industrial side of our markets, Naspers had a great run, but the overall industrial index is up around about 20%, a bit more than 20%. The banking index and financial index is up around about 15%. So where did that 30% come from? From resources. The resource index is up around about 120% year on year. Now, the mid caps also up around 20%, which is the second line South African companies, but it's a resource driven market. The challenge with resources is we do have every now and again, you will have a great resource run that lasts for a year, 2 years, 3 years. But the point is, it always comes back at some point in time. Somewhere there's a liquidity event. That's what history tells you. And I think one can't say this time it will be different. What you can say is you don't know when it's going to happen. You don't know how far it's going to go. But history tells you that resources can come off quite violently. I don't know when it's going to happen. I don't know what it's going to trigger. I don't know how long this is going to be, but we just need to be careful on that. But that's not the only story. There's actually, if you look back at the year, there's reason to be optimistic.
I just want to stop. So liquidity event is a nice way of saying the party stops.
Well, it's a nice way of saying the parties. And if you know into those jargon. Kind of jargon,
yeah.
You can always say resources goes up by way of the escalator or stairs and come down by way of the lift or the elevator.
Yeah.
And that's kind of jargon in resources, but it's been a good year.
It has been a good year. And I think we, maybe just the one thing to contextualize is we obviously know we can't forecast what happens into the future. What we can do is we can look at where we are and we can look at previous iterations of these kinds of movements. And I always think history helps you to understand and to give it context. And the context a lot of people must remember is we're coming off a time when interest rates went up 10 times in the first world. Not so much in South Africa. We did have rising interest rates. And to me, interest rates are the tsunami that lifts or crashes markets. So when interest rates in the UK, for example, go up 10 times, if you think about your mortgage, goes up 10 times, that is a huge impact. So we're coming off that cycle now where interest rates are trickling down all around the world, including South Africa. So we're not sitting here and saying, okay, we can predict that the JSE will go up 30% again. That would be silly to do. But what we do need to say is investors are being paid for some of the lost growth that we got in 2022. We there were big losses all around the world. And then some of it is probably overvaluations in the US tech market. But I think we are facing quite a lot of questions from clients saying, is this now a big crash? Are we 2007 or 1999? Are we in that kind of a sphere? And I think the difference in at the moment is interest rates tell you a big story. Interest rates are the version of gravity, and if interest rates are still coming down because inflation's sort of under control in a lot of these big markets, including South Africa, then we know that is a very positive trend. That just adds to the other stories. I think South Africa is it feels strange to be talking about South Africa and saying positive things about the economy, because we haven't really had a chance to do that. So maybe on the negative, unemployment is still incredibly high, but unemployment's a little bit less bad than it was in previous reporting periods. That's worth noting. If we go back and we look at the budget process in March, it was lousy. I mean, we were at a point when the government of national unity was all threatening each other again, and everything was going to end, and all, everyone was throwing their toys. But we got through that process. There were learnings. And I think where we are now in the medium-term budget, which is, for me, the real nuts and bolts budget, we saw that it was a fairly, I don't know what happened behind the scenes, but to the cameras, to us as South Africans, we saw a fairly consensus budget where obviously there was discussion, obviously there was debate, and then there was a direction, and it was a very good budget. If you're talking to someone about personal finances, what you would say is you have to spend less than you earn every single month. When you talk about it as a country, that means you have to run a primary surplus. And we are running a primary surplus for 2 years in a row, and the budget's telling us we might well do it for 3 years in a row. That's very good, because it means that we're spending less than we earn, so we've got a little bit more money to pay off debt. Because when you add debt to the equation, we're still spending too much money. So we are going to pay down debt a lot faster. Equally, that we're in a position now where we've gone off this grey list. And I think grey list is, it's something we shouldn't have been on, but we did. We got ourselves off. It wasn't in record time, but it is one of the quicker turnarounds in a country's fortunes. Add to that, we then get a ratings upgrade from Standard & Poor's. We're still junk, and instead of being 3 levels below junk, we're now 2 levels below junk. And that might sound like kind of snapshots of pieces of news which are mildly positive. What we need to know is when you look at an economy and you're a global investor or a South African investor, what really counts is momentum. What we've had pretty much since 2007 was very negative momentum. Everything was counting against us. We were shooting ourselves in the foot. We had global trends working against us. Now we're starting to do things right as a country. So that momentum is building in a positive direction. It feels to me like we've gone from digging the hole deeper to flatlining and now digging ourselves out of the hole. And that momentum can carry on. So I wouldn't be surprised through 2026 and 2027 if we don't see more ratings upgrades, if we don't see, for example, inflation getting better again, which means more interest rate cuts. So those are very positive signs. And I know I'm talking a lot, but a lot happened in this budget. And one of the other things that happened in the budget was we get consensus between the Reserve Bank and the government, so Treasury, saying we're going to target an inflation rate of 3%. In the beginning, when this started kind of bubbling under, we weren't that strong on why this is good news. It felt like almost academic by the Reserve Bank. But now we start to realize there are real positive spin-offs for the country as a whole. What it means is it's showing investors, global investors and local investors, that we are really fiscally disciplined. And that's another nice phrase, fiscal discipline. And we are showing that we can control our spending, that we're not overspending on the wrong things. And equally, what that means now is that when the government issues new debt, they don't have to issue it at 11% because you're issuing it at inflation plus. So you're not going to issue a new debt at 3%, which is inflation, plus 8%, which gets you to 11. You're going to issue at 3% plus 5. So that gets you to 8%. And when you're issuing dollar debt, which we do a fair amount, and the rand is strong, you're now in a position where you're starting to issue debt at a better interest rate. It's more affordable for South Africans, and rand debt will be the same. So now we get to the situation where that interest cost, which is enormous for us, becomes more and more palatable, and we can knock that debt faster. What the Treasury is telling us, what the budgets are telling us, is they're not going to use this breathing room to spend more. They're going to use the breathing room to actually pay down debt even more quickly. So it could be at a point where our debt relative to the size of our economy goes to somewhere around 77 or 78%, but turns faster and earlier. And for me, those are real big things that we should be focusing on to say the country is going well. We're not talking about Eskom. We spent so many of these things saying, look, load shedding will end one day, et cetera, et cetera. We're through that now. We're learning that the Cape Town port had I think it was a record citrus export, and that the Durban port is slowly but surely working itself off the rankings of being the worst port in the world. those are all good signs.
There is, and I think we need to appreciate that. But if we look forward to the year, I think we have to appreciate a few things. And this is not predicting; it's more saying events that is going to happen that might have impacts, and not necessarily trying to predict the impact. So if we look at the year, obviously we will have the budget somewhere February, March, and I think if you look at what happened in the medium-term budget, it will be a smoother process. There's more alignment, so we're going to have the budget. Then in round about August, the DA, which is the second largest party in South Africa, the official opposition, and a core part of the Government of National Unity will have their leadership election. Will that be re-election of Mr. Steenhuisen, somebody else? I don't know. But there will be a re-election, a leadership election in April. Then you move on to November. Now, in the first week of November, actually the 2nd of November, we have the US midterm elections. And what is important, it's not a presidential election, but they elect the whole of the delegates, everybody in the House of in the House of Representatives, and a third of the Congress. Now, the point is the House of Representatives usually, in a midterm election, the momentum goes against the incumbent president. If you assume that, that means there is a chance that the Republican Party or the Trump White House might lose control of the House of Representatives. And because he can't stand a second term, he will be, if that were to happen, he will be what they commonly refer to as a lame duck president in his last term. That could play out. I think that'll depend on the next year. And a year's a long time. A lot of things can differ, but at this point in time, that's the next big milestone in the US system. South Africa will have municipal elections somewhere around November, December next year, or January the following year. And what we have to assume is there'll be incredibly difficult, aggressive campaigns in the big metros in South Africa. In Gauteng, KZN, it'll be, the MK will play a major role. In Gauteng, it will be the ANC and DA, MK, all of those parties. But we have to appreciate that will be very hard, aggressive campaigns. And on top, we want to keep the Government of National Unity in place. So expect that kind of volatility. Expect a lot of noise, and at some point, politicians will go into election mode. Remember, when they're in election mode, they're almost in a permanent interview for a job. They try to get their base, to mobilize their base. And they're not saying things that's in the interest of us all. But I think we just need to be careful. That could be things that makes the year difficult.
Yeah, and I think also we need to see how the NHI story unfolds. I mean, I think there is more and more news, opinion pieces being written by people, let's not say news, where they're saying, even within the ANC now, there's not consensus that NHI is carrying on in the way it was done.
I think what is key is that NHI, even if you take the people that support it to the fullest, it's a 15-year process. And remember, in 15 years, there's elections, there's presidents, there's political parties, things change. So I think one must be very careful. If you can't predict what will happen in a year or 2 years' time, it's almost impossible to predict 10 or 15 years ahead. And I think that's also stuff that we just need to keep in mind when you look at those kind of things. They usually never play out as you thought they would play out.
Yeah. And I feel, I think it's something like 7 court cases challenging NHI. And so some of those might unfold through the year. And so between the political solution, which might not land as quickly as we would like, and maybe the legal solution, we might see that this thing gets ventilated and hopefully there's some sort of sanity prevails. I think just important, we've always said all along, even as a business, we believe in universal healthcare. We think it's important, just not this way. And I think, we're not political, but it's key for the humanity of our people.
I just want to take you back to the inflation target you talked about. Part of our financial planning when we advise clients is to project their income and their expenses over their lifetime. Because that's a critical part to make sure to what extent clients are financially independent or financially self-sufficient. So we've always used as our inflation projection, we use the upper band of the 3 to 6% band. Now that we're at 3%, target range with 1% up or down, how do we view that?
Tricky. So it's not. It's a process. So we would say this inflation target we think is very good for the fiscus, so for the country as a whole. We used 6% instead of a range because we always thought there isn't a really accurate measure for the cost of living changes for our clients, and so we're going to stay at 6% for time. I'm not going to say it's for a year or it's for 2 years. We think that we need to look at, for example, the general basket of goods that our clients would be buying, but also maybe what medical aid costs are doing. And at the moment, the inflation target might be 3, but medical aid inflation seems to be around about 8. And so if medical inflation comes down and it gets closer to 3%, maybe that's a good proxy for us adjusting. But we'll stay on 6 now. What we do say to our clients is we will watch this space. We will continue to look at this, and if over the next 2 or 3 years things kind of get closer and closer to 3, maybe we adjust. But it served our clients well to use that 6%, and we think it's the right measure for now.
Again, erring on the conservative. Remember, the further you look ahead, the more difficult it is to predict accurate. So whenever you make an assumption, err on the conservative, or err on the outcome to be better off than you predicted, and not the other way around.
Yeah, we would rather have a positive surprise and someone's late in their 80s and say, look, you've got a bit more money than we planned. That's a much better scenario. Also maybe just through next year, one of the things that we get asked a lot is, American market's very expensive, and be careful. And you showed me that research where you look at the American market since 1950. If you start in the American market on the 1st of January and you sell your investments on the 31st of December of that year, you would expect over an average, and averages hide a lot of noise, but the average would be that you would be 11% better off. However, when you measure what happens through that year, what will happen is there will be a point in that year where your investments are down by 18%. Maybe not from the 1st of January, but let's say
somewhere in the process.
Yeah, you go up, and by June you're up, you've gone from 100 and you're now at 120. At some point it won't be 120, it might be 102. You've gone down. And then it recovers again. And so understanding that those kind of big moves in the American market, which we would see right across the world, are normal. So if we get a big downward move in 2026, the liquidity event, understand that that's normal, and we're not chopping and changing our investments in line with that. What we are doing, and we are very disciplined about that, is making sure our clients are not overexposed to the big tech shares at the wrong time, that they're not overexposed to the whole of the US at the wrong time. In fact, we might be accused of being a little bit underweight America right now relative to how big it is in the world index, and that's okay. We would rather be away from the most expensive parts of the market and in the parts that are doing better. So I think we are well positioned. The bond market's done incredibly well for us because we had exposure there. And that kind of asset allocation spread, geographic spread, and style of investment spread has worked very well for our clients. And so when we say it's a good year, we're not taking credit. We're taking credit for diversification and for rigid asset allocation. And that process works well when markets go down and when they go up. So a lot of the reviews we're doing now are making sure we've got the spread of assets right, they're appropriate for our client, but not based on forecasts.
And I think that's the key. And in the end, it's all about diversification. You're never going to be able to judge which share, which asset class, which will perform best next. But you need diversification. Warren?
I think that's a good way to wrap up.
Yeah, thank you very much. It's been a great year, wonderful year. And I just want to wish all the clients, all our staff, all our friends, all the best for the festive season. Treasure these times with friends, with family, and we hope we have a blessed new year, and all the best.
Thank you very much.